Welcome to the Ken McElroy Show. Today on our show, we have Mauricio Rauld, and him and Ken just co-authored a book called The ABCs of Raising Capital. So we're going to be discussing that today.
Yeah, timely book, man.
Dude, big time.
I know.
Big time.
Raising money is hard.
Getting harder by the day, too.
Well, it's supposed to be hard. Yeah. What we just went through was easy.
If it wasn't hard, everybody would do it.
I know. And just for some perspective, I mean, why don't you tell everybody, like, you were an attorney that did a lot of the private placement memorandum. You had lots of clients. I don't know, how much money did flowed through your...
We've lost track. It's over $5 billion. It's probably closer to 10. At some point, it's just a vanity number at some point. But yeah,
Sure.
we did it probably. I mean, we were doing 200 of these every year. I mean, at our peak. So, yeah.
So you got an insider view of deals, because if you guys don't know what the PPM is if let's say I tie up a deal and then I put a business plan together. Well, that's just one piece. Then I give it to Mauricio, and he actually puts what's called a PPM, right?
Yeah,
around that.
Yeah, private placement memorandum. It's your disclosure documents, which are required.
So you saw hundreds and hundreds and hundreds of deals at once, right? Oh, look at that.
There's the book.
ABC.
And today we'll be talking about the ABCs of raising capital.
But I think what's interesting, though, for those of you listening that aren't trying to raise capital and you're investors, we're also going to be talking about what you need to be looking at when looking to invest in something from someone who is raising capital. So we're really hitting both directions.
Well, I think the real issue, if you were to pinpoint it, when money's easy to raise and deals are closing and everybody's making money and there's all this, call it party time, nobody really looks at anything.
Yeah.
Right? So, but when it hits the wall, like it started doing, that's actually when all these agreements come out. That's why this book is timely, because there are things in the book, clearly, that are going to prevent you from getting in trouble if you want to be able to get into the raising capital business and buy stuff, because most people don't have money. Most people find a deal and then they need it. And so the book is going to walk you through some of the very, very basic moves that you need to put in place before you actually raise capital.
Yeah, so let's talk about the last few years, because the last few years really created a lot of fear in real estate, especially in multifamily, based on these interest rates. So do you think investors are fundamentally looking at risk differently now?
100%. I mean, I'll tell you one thing there. I can guarantee you they're not considering these investments ATM machines, which I think is what they thought of these things before. So in the past, literally the last 5 or 6 years, I think investors were putting in their money, 50 grand, 100 grand more, and they just assumed cash flow was going to come back like an ATM machine, like guaranteed 10%, 15%, whatever. And obviously that's not how real estate investing works. And now we're starting to see more realistic stuff. So people are now looking at the risk, the risk profile and the risk of the return as opposed to just the return. I mean, they literally used to look at two pitch decks, two deals, and look at the ROI and say, well, this one's higher than this one. Let's go with the higher ROI. Mm-hmm. When in reality, that's, you've got to look at the risk adjusted return, which I think they're starting to look a lot more at these days.
Finally. I mean, this is the way it was supposed to be. What happens in times of easy money, people they get rid of the basics, right? The fundamentals. And the interesting thing about your job, Mauricio, as an attorney, is you don't actually look at the business plan critically, right? Like
not from an investment standpoint.
Right.
Like I literally have to separate myself, because I'll look at a business plan sometime and like, I would never touch this deal, but I'm not going to tell the investor that. What I'm going to do is make sure that we're disclosing all of the risks for that investor. So that was my job. My job was to identify the risks and disclose them. Whether the deal was good or not, I stayed out of that.
Hold on. You opened the door here. So wait a second. So let's just for a moment. So I know you've looked at hundreds of these deals.
Thousands, probably.
Okay, thousands. So you've looked at business plans and going, there's no way anybody should invest in this.
100%. Like I'll see sometimes a business plan that'll say, oh, we're gonna get you like for example, I'm gonna get you a 30% return. I don't know about that, but I need to make sure that the investor understands all the risks that go associated with the 30%, that it's not guaranteed, that all these things could go wrong. Maybe it hits 30%, maybe it doesn't. This is our best estimate. Like all those disclosures that are required. That was my job. But my job wasn't to sit there and say, this deal, I've re-underwritten this deal and there's no way this thing's going to produce 30%. That was not my job.
But there's deals that you look at and you say the same thing, right?
I would never
Ken?
give them to Mauricio though. That's the difference. No, there's a big difference here. Like by the time I give something to Mauricio, we actually beat the deal up.
You're right. Sure.
We want to make sure that we've considered all the risks. And in many cases, we have, but in some cases we haven't, right? But what we're talking about is very different. What we're talking about is a syndicator that can raise capital and is basically putting things on a piece of paper in the form of a business plan that nobody should really invest in.
Yeah, I mean, when you're looking at a business plan, especially I focused a lot when I was doing these deals on the pro forma, right? So the syndicator will put together sort of a 5-year pro forma, which basically just means sort of a projection or an estimate as to where they think rents will be going in the next couple of years and all of these underlying assumptions. And that's what I attack. Not necessarily attack, but that's what I want to uncover. What are the underlying assumptions? And that's something that an investor, if you're looking to invest in a deal, that's what you should be looking at. What are the underlying assumptions that the syndicator or the investor is making? And then critique them. Do you agree with them? Do you not agree with them? Do you think they're a little over optimistic? Do you think, the assumption of 5% rent growth might be a little too high? Maybe I think 2% is more realistic. I mean, you should be questioning and asking all these questions, even if it's just your own mind. And maybe you just re-underwrite the deal yourself and say, well, I'm going to assume a 2% rent increase. I'm going to assume this. I'm going to assume that. And then look at the deal, and the deal still may make sense. But don't just blindly accept that because the pro forma says we're assuming a 5% rent increase, that's what they're going to get.
And I think that's kind of the point is you can put anything you want together in any kind of a business plan. You can make up whatever you want. And the question is how does the LP or the limited partner actually ask the right questions, right?
Yeah.
And what you're trying to do is protect the GP, the general partner.
Yeah, that's my job.
So your job is to protect the general
I
partner.
don't-
And what I would love in this podcast is for you to also weave in what should the LP, the limited partner, maybe with limited knowledge, limited investing knowledge, limited real estate knowledge, what are some of the things that maybe they could ask or should ask? Because I know the difference. Obviously, I would never take a deal like that and project any kind of return like that. And I know you've seen those kinds of deals.
Yeah. Yeah. I mean, from an LP perspective, I think one of the most important things they should be asking themselves is, who is this sponsor that I'm giving the money to? What is their level of experience? Can they pull off the glossy pitch deck and all these pro formas? What is their ability to pull up? Do they have a team? What is their experience? Like, those are probably the most important questions overall. I think LPs tend to get enamored with the deal itself. And the deal, I mean, it's important, obviously, the deal and the numbers and everything, but it's almost like the most interchangeable part of this whole equation. The most important thing is is the sponsor. And I think during the good times when you could literally throw a dart at a board and make a bunch of money, I think that focus went away and people weren't really looking at who the sponsor who was taking their money and putting it to work and executing a business plan. They weren't really paying that much attention to that.
I say my rule of thumb is if you're 35 years old or younger, don't invest with them. If they have less than 10 years in this business, then don't invest with them, right? Like
what if they have a W-2?
No, not at all. I mean, they have to be a full-time investor. They have to be in the business. It can't be a side business. And, because what happened is this industry turned into a capital raising business, right? The fundamentals all fell apart, right?
Can I touch on? I'm glad you touched on that, because this is one of my biggest pet peeves in the capital raising business. Is people forgot why they're raising capital and they just started raising capital. And at the end of the day, the reason you would want to raise capital is because you're good at something, whether it's you're starting a business and you're good at it, or you're in the real estate and you're really good at delivering a return on the asset, but you've just run out of money, or you can do better if you scaled it, or you've got more opportunities if you scaled it. So you're raising the capital to expand on your existing business. There's way too many people out there that are just raising capital for the sake of raising capital, getting into groups together, raising capital, just giving it. They have no idea what they're doing. And I think people have just lost their way of why you're raising capital in the first place.
That's a good point.
Yeah, and I think that brings me to my next question, which is, previous to 2020, people did not really raise money through the internet. A lot of people, they MC companies, you did conferences and connected with, different investors. But then in 2020, where everyone was home and everyone wanted to raise a bunch of money and people were getting stimulus checks and PPP money. So all of a sudden, one of the prime things with all of these advertisements to, invest in this fund or invest in, with this property, with this syndicator. And do you think that now that we're in 2026, that that's still the way to raise money? Or do you think it's going back to more old school ways of raising money?
The idea of advertising your raises, like raising money on the internet, that's been around now since 2013. So it's been a while since it's been around. I think what people forget is that this is a relationship business. And even though you can just advertise on the internet, people still want to know who you are. They want to know what your background is. They want to know if they like you, that they know your experience, and that they trust you. At the end of the day, trust is a big factor. And you can't just do that by just throwing up a Facebook ad or a LinkedIn ad. You've got to enter into those relationships, even if you may not be legally required, which sometimes you are, to enter these relationships. Just having that business relationship, going to conferences like the old school, and having a social media presence is important, but just throwing something up there and getting people to throw money at it, I think those days are long gone, because it's on both sides, right? The money was easy, but also multifamily got to the point where it was kind of easy. Like, you literally could throw a dart at any building and you would be able to make a return for your investors, having done nothing of skill in that property. Just because the property values went up, the rate caps compressed, there was no adding of the rents, there was no adding of the occupancy. The prices just went up, right? And that's no longer the case. Now you actually have to do the work. You've got to do the asset management. You've actually got to execute on the business plan, which is something you didn't really have to do back in 21, 22. And in fact, a lot of people are starting to sort of say, look, if you looked under the hood in 2020, 2021, a lot of those returns are just based on the market helping you, not because of any skill that you had. Now skill matters.
But interest rates were a part too. That was a huge part too.
Yeah.
Now, how do you, when people are investing now, how do they hedge the interest rates when they're looking at deals?
I think they're just paying more attention to the return and the risk associated with return. Like, I'll give you some example. Like, people now are looking at things that they would never look at 5 years ago, like cash call provisions. Like, nobody ever cared about what cash call provisions look like. Now everybody wants to know what the cash call provision is. Financial reporting, or reporting in general. Nobody cared about reporting. That was a big issue in the last few years, and a lot of people lost trust because they weren't communicating. Now they want to know, hey, give me a sample of the type of reporting you do in the past. Like, what exactly are you going to be giving me? How often are you going to be communicating? What if something goes wrong? Are you going to? All these questions, people are now starting to look under the hood and actually ask those questions, when before it was like, here's my money, I'm just going to assume you're going to give me a 10, 15% return.
Well, I've fallen into that before, and I think what so what we're talking about here is if something changes materially in the deal from what the business plan was, then it's on the syndicator to be able to communicate that to the LPs, right? So that could be interest rate, that could be something to go with property tax or a big capital need or something, whatever it is. But that is the point. And so what I kept hearing was people are like, the deal's great, the deal's great, the deal's great, cash call, right?
Right. Yeah.
And so and that's what you're saying.
And sometimes even more extreme, it was like, deal's great. Then I read in the Wall Street Journal that my property got foreclosed on and we lost it. I mean, that's the extreme it got to. So, but communication is just such a big part of being a syndicator, and I think it's something now LPs are paying attention to. I mean, I know a lot of investors who, comparing two deals, maybe they're going to lose both of those deals, but in one scenario, the syndicator was transparent. They were explaining exactly what they're doing, working hard, trying to fix the problem, communicating, doubling, tripling down on communication, as you like to say, Ken. And then there's the other one that just stuck their head in the sand and didn't communicate. The investors are more likely to go back and invest with that other. So even though they lost their money, because they continue that communication, because they trust that person, they'll reinvest with that person versus the person who just disappeared and stuck their head in the sand.
The other thing that I found is that what happened was, during this last run, we had a lot of people that were, call it online influencers, raising money. And so they raise money, and then they just would pick somebody, like in some market somewhere, ABC management company. And they would say, you are going to be the recipient of my capital. And then they would just walk away.
Yeah.
Right. And so the issue is that the money, the relationships came through the syndicator, but then they've kind of transferred, that responsibility and all the things that come with the money
Yeah.
to somebody else that maybe they don't have a long-term relationship with. And also when they show up at a property or a market, they don't really even know what to ask.
Yeah, that's my pet peeve of people just raising money for the sake of raising money. So what you're describing it was a phenomenon that really took off a few years ago, which is this idea of a fund of funds where they would raise money into their own syndication, but essentially then they would just write a check to the underlying syndication. And a lot of times they wouldn't even know anything about the asset class, or they would just pass on the underwriting from the underlying syndicate to the investor. Like if you actually sat them down and asked them specific questions about the project or the deal or the market, they had no clue. All they were good at was actually raising the capital, and there was a way for them to monetize.
So how could an LP, protect themselves in that scenario? What could they have asked? Because I saw that happening a lot. I had a guy from Austin say, "Hey, I raised a bunch of money with my group. What do you have?" I'm like, "What do you mean?" You know what I mean? I'm like, that's usually we have a deal that we're raising money on, but in this particular case, he just put a pool of funds together and was out looking.
Yeah.
It was clear that I could have said anything, and I probably could have gotten that money.
Yeah.
So how do you protect the people when they don't even really know where the money's going?
I mean, I think it goes back to this idea of understanding what the qualifications of the sponsor is. Like if you're going to give this person money, you need to be asking all the questions. And if you're interviewing this person and they don't quite understand the asset class or where the money's going, or they can't really answer your questions, I think that's a huge red flag. Alternatively, you would generally want to talk to the person who's actually, doing the operational part. But a lot of times in these fund of funds, you're not going to have access to that person. So again, another red flag. You have to get your information from your sponsor who's doing the fund of funds. And if they can't explain it to you, what all the risks are, how it's going to work, what if this happens, what if that happens, why this market, why this property, why this loan product, like all of that information, that's part of as an LP, it's part of your due diligence. I mean, once you write that check, you have no more say in the deal. So all of your say happens before you write the check, and that's interviewing the sponsor and asking all those questions.
Well, one of the interesting things is of a deal, guys, and we'll just walk you through this. There's typically a general partner who puts the deal together, and then there's a limited partners that come into the deal. So when you actually do fund to fund, you're actually even one more removed. You actually have nothing to do with the general partnership of the deal itself, right?
Right.
So sometimes I've seen there's another general partner with another fund.
Yeah.
So you've got a general partner underneath. I know this is a little confusing. But you've got a general partner underneath another deal that has a general partner, right?
Yeah, and these fund of funds, essentially the fund becomes a limited partner because they've raised all this money into their entity, their LLC usually, and then they're just writing a check to the underlying, like I'll write a check to you, Ken, from my fund. I'm just a limited partner in your deal. And so my investors become investors in my fund, but I'm just an investor in your fund. And a lot of times it makes sense. So I'll give you a good example. Like some of these funds are so huge, right, where the minimum investment might be $5 million. Okay, well, it's a great deal. I like the deal, but I don't have $5 million. And even if I did, I don't want to put my $5 million. So somebody can create an LLC or a vehicle for me to receive money at a lot lower amount. I can put $100,000 minimum into this fund, and then we can aggregate the $5 million, and then I can invest in a deal. So it gives me access. There's value in these fund of funds. But when they're just doing fund of funds just to kind of raise money as a capital raising tool, that's where I had an issue with it.
So if you were going to invest in a fund of fund, you then need to check on your own GP and trust that because they can really put your money wherever, so you have to trust them.
It depends on they have to comply with all the securities law. So they're going to do the PPM that we talked about earlier. The attorney is going to put together a private placement memorandum for that level. And that PPM is going to explain where that money is going to go. Sometimes there's a pre-identified deal. So again, I'll use Ken as an example. Ken's raising money for a specific deal. I come in and raise a little bit of money to invest in your deal. Sometimes it's just a blind fund. I'm going to go raise a bunch of money, and then I'm going to go find different Kens that I like and trust and kind of like what they're doing, and I'll allocate some money to all of those. That's the more dangerous one because the investor has no clue. It's almost like a mutual fund at that point. I have no clue where my money's going. If it's a project specific fund to fund, then I know where my money's going. But you're just, there's just a lot of layers of fees that are going. You're getting double feed everywhere because you're not investing directly with the operator. You're going through another vehicle.
Plus, you don't necessarily have options, right? Like if you're an LP and they do a cash call, you can decide whether or not you want to do that cash call. Where if you're in this fund to fund and your GP decides to not do a cash call, then you don't really have that decision, right? That's kind of their decision.
The cash calls are, you have the decision. They're never mandatory, because if you start making mandatory cash calls, nobody's going to invest. So they're always optional. But yeah, there might be a cash call from the underlying syndicator. So now the fund has to come up with capital to do its cash call, and that fund's going to get the money from its investors. And so it's just a trickle-down event. And if those investors don't sufficiently put the cash call in, then that means the fund won't be able to do its cash call. So it gets tricky.
But let me explain how nuanced this could be. Let's say Mauricio is putting together a deal, and he's a GP, let's say 25% GP, 75% LP. Pretty standard deal.
Yeah.
Okay. Then he comes to me and he says, I need money. So then I go to Danille and I say, give me $1 million. So now you've given me $1 million, but I'm also a GP. So I'm taking a fee on your $1 million, and then I'm giving it to Mauricio, and he's taking a fee on the bigger pie. And so that's what he means by multiple fees. So if you bypass me, Danille, and go straight to Mauricio, then you save on a fee.
Right. Unless I just can't afford to invest with him because he needs.
And that's the main.
But you can, because it's the same money.
Yeah, but the main I think the original purpose of these fund of funds were like Ray Dalio comes to mind, like his Bridgewater fund. It's like I don't know if it's not a billion, but I think it is like $800-900 million. So when he goes out to do a raise, he's raising hundreds and hundreds and hundreds of millions of dollars. So they're buffer ones, like Sequoia Capital is a good example. They'll put together a fund that their fund might only be $100 million. And so they'll raise the $100 million with smaller minimum investments. And it can trigger all the way down to, if Sequoia's minimum is $5 million, like I said, I might be able to put together a syndication where my minimum is $50K to come into my deal, and then we'll aggregate the $5 million. So it does sometimes give access to deals that you ordinarily don't have. You may not have a relationship. A lot of these big, again, this is not applicable to really what in our world, but like the point of a fund of funds is like sometimes you don't have the relationship to get into that deal, right? If Elon Musk was looking to raise money for X, you're not going to be able to invest directly with Elon. He's going to go through other intermediaries. And so the only way for me to invest in X is through one of these intermediaries. But the fund of funds that happened over the last few years, they were just mechanisms for people to raise money because they could.
It's a little bit different, but it's a great question you asked, Danille, because sometimes it is access. But what happened is that all got kind of muddied.
Yeah.
And then it just became these individuals raising these funds with their Rolodex because they went to some seminar somewhere. And then they decided to just invest. But they don't know the right questions to ask in a lot of cases as well.
But they also did it because the ease of it, right? Like if I was going to promote on social media, I would then have to first find a deal and then try to, get an offer on it, or link with somebody that had a deal and then raise money for the deal. But it'd be much easier if I could just pound on my Instagram and just raise a bunch of money and then just
now you're getting into securities law here.
Yeah.
That's right.
Perfect.
And the risk, and I think a lot of those types of syndicators are finding out, is they also didn't want to do the whole compliance full-blown PPM. And so they would literally take the PPM from the underlying deal and just use that for their investors, right? And the problem with that is that if the underlying investor missed a disclosure, the underlying syndicator missed a disclosure, then by definition, I miss a disclosure because I'm just relying on your disclosures. And so there's always a risk for the syndicator as well, because if the underlying deal goes south, there's a good chance your fund's going to go south because whatever the problem is down there is going to be the same problem you're going to have because you're just borrowing their docs and you're not doing sort of an independent due diligence and an independent risk disclosure.
But also, Danille, you brought up something really interesting. You can't just put a deal out online. Unless you designate yourself. There's a 506B and a 506C. They're two different lanes. So you can imagine yourself going down two highways. One highway you can do it, one highway you can't do it, right? So I think it's important that you walk us through that. You can't just go online and say, I'm raising money for this, right?
I still see people mess this up. So there's an exemption. So whenever you're raising money, you have to either register your syndication with the SEC or you have to find an exemption. And the exemption that you're talking about is called the 506C, which allows you to advertise and general solicit. So it does allow you to go on social media or on YouTube or what have you and kind of talk about your deal or promote a webinar you're doing, or there's ways to do that, right? But you're going to be limited to accredited investors only, and you've got to follow the rules of 506C. There's several steps. What most people mess up, even to this day, I see it, is that people think that because I can advertise, I can just carte blanche, put whatever I want on Facebook, and I can say, hey, I've got a deal. We're getting a 2x return, and we're doing 15 to 18% IRR, like all of that stuff. And what people always forget is that in addition to the 506C, there's something called the anti-fraud statutes. And the anti-fraud provisions essentially say you can't really post anything without giving the full context. Like, you can't just say you're going to double your money because you forgot to add all the risks that go into potentially doubling your money. So yes, you can advertise, but you're very limited as to what you can say on a social media post. I would limit it almost to, hey, we've got a deal. We're doing a webinar on it tomorrow. Please join us. Here's a link, and let's
Even
go.
as sophisticated as we are, what I say is, if you're accredited, click here, and you will show you a business plan. But we almost never talk about the returns or anything like that. You're crossing as my partner Ross would say, you're going from the bay to the ocean.
Yeah, and the nice thing about the clicking is that once you click on that link, you go to a landing page, and now there's room for you to put all those disclaimers and disclosures. Hey, you can't invest unless you're an accredited investor. You've got to review all the PPM. You've got to do that. Like, I've got room. When I'm doing a Facebook post, there's no room for me to put all that stuff in there.
Right.
So we're seeing banks tighten right now significantly on lending. How is that changing how you raise money?
That's a great question.
Well, for one, it's the down payments are a lot more.
Right.
Yeah, that's one thing. When money's cheap,
Right.
the loan to value is high, and you're not putting as much down, right? So they've adjusted.
And the returns aren't, like, if you look at returns on those business plans back in, again, 2021, 22, they were like 18, 20, 25%. I don't see those anymore. Like, those are, now we're down to more the 14, 15% on the high end of an IRR. And that's because the cost of capital has gone up. So you have to adjust on that. And again, I think investors have become a little bit more sophisticated in that they just don't assume that whatever you put on the business plan is what's going to happen. And so they're starting to really double down and look at, okay, I know you're saying that I'm going to get a 12% return, which is better than I'm getting at the bank, but how are you actually getting this return, and what are the risks involved, and how likely is this going to happen, and what if this doesn't happen, and all those things.
But I also think it's a great question. You need to talk about what capital or what equity really is, what money really is. It's either debt or it's either equity, right? So one or the other. So the deal needs 100% of cash, period. So debt is typically anchored to the property in the form of a collateral, right? So it's typically considered less risky. So debt is typically priced less than equity, typically, right?
Right.
That's a really important point. And so if 50% of the debt is, let's say, 6%, and 50% of the equity is, let's say, 10%, then the cost of capital is 8%. It's just right in the middle. So equity is typically priced more than debt. And so what's changed is as the interest rates have gone up, the price of debt has gone up. And so therefore has the price of equity also gone up. And so what does that do? Both are a cost of the project, right? So don't forget, all that money, that 8%, is paid out of the project, right? So if the project doesn't make 8%, then you're not paying back the equity. You're paying the debt first at 6%, and you're only paying a portion of the amount that you owe on the equity.
Yeah, and syndicators have also become more creative on the structure as well. For example, like there's this emergence of sort of debt funds that have popped up a lot. So a lot of folks are doing debt funds now because they seem to be a little bit easier,
less regulated.
Yeah. There's a lot of this. A lot of people are doing like preferred equity as well, which is another kind of a mezzanine debt piece. So they've added additional things to their packages to make it a little bit more attractive for some of the capital. And then people are starting to do some joint ventures too, because it's just getting tougher and tougher to raise that capital.
So can you explain what a debt fund is and what preferred equity is?
Yeah, so preferred equity is the investor will get a certain percentage of the return before the rest of the equity gets their money. The debt is always first, as Ken always like to say. So you're going to have a mortgage and you're going to have to pay the mortgage first. But then whatever typically would have been available to distribute to the investors, we're actually going to split that up in two as well. There's going to be a group of equity investors that are preferred equity. So they're going to get all of the money first until they reach whatever hurdle, let's say 10%. And then anything above 10% will go to the next level of equity investors. The good news is the pref is a little bit more protected because they're next in line. They're not first in line, but they're next in line. The downsides are they're going to be capped. So they're going to be capped at 10% or whatever the number is versus an equity player potentially can go much, much higher. But that's generally the difference with preferred equity. And then what was the other? Sorry, what was the other?
The debt fund.
The debt funds are literally people are raising capital to then lend money to syndicators. So instead of the syndicator or the project owner, instead of raising equity, they tap into this debt fund, which is, again, they're getting a loan from that particular entity. So it's the loans aren't the interest rates are still higher than you would think in terms of mortgage. These are not 6, 7, 8% mortgage loans. They're still 10, 12%, almost kind of hard money, but it's still cheaper than equity. To your point, Ken, as the debt's gone up, the equity also has gone up, and so it's still cheaper than equity if you're going to get the debt fund. I can go to a debt fund and borrow money at 10% or 11% or 12%, for example.
So, okay, I need clarification because I know people are confused listening too. So say that I am a syndicator and I need to raise $10 million to buy a building. Are you saying instead of raising money from investors, I could pool the $10 million from a debt fund and just pay the 10 or 11% interest on that?
No, I'm talking about two different things. So if you're a syndicator, one thing you could do is you could raise a debt fund, meaning I'm getting money from my investors to then lend it out to an operator who's looking to acquire a piece of property. On the flip side, it's like if you're an operator and you need to go raise money, you can either do a straight syndication, which is I would go raise the equity and do my typical GP-LP split, or I can go to a debt fund and say, hey, debt fund, why don't you loan me the difference between what I need for my equity? Like I've already got a loan that's maybe 70% of the acquisition cost. I need that extra 30%. I can go to a debt fund and get that 30% from the debt fund instead of raising the equity myself.
So then you would be the only owner, essentially.
Correct. On that side of it, yes.
Okay.
Yeah, and I know we cover a bunch of that stuff in the ABCs of raising capital, right? I think it's important, again, as you're putting these deals together, that you understand these. I think they're very, very good questions that Danille's asking. You know, the way to look at it, again, going back to the example I had before, is it's just money. If you pull $100 out of your wallet, you can actually lend that in the form of debt, or you can lend that in the form of equity. It's really your choice, right?
Yeah.
I mean, literally, you can decide. You can decide, I want this to be debt. I want this to be equity. And equity is more on the investment side. And that's where that preferred return comes in. On the debt side, there's usually a fixed or a floating number or something like that tied to some kind of an index. Right?
Yeah. And what I like about, remember when you're raising capital, we talk about, and what I love about it is you insisted that we put this in the book, but it doesn't mean you have to be raising money from other people. Like that's other people's money, right? That's what we're generally talking about. But there's ways for you to raise capital from your own resources, right?
Correct.
You know, the cash out refinance of your home. If you have your residence has some equity in there, you can actually tap into that equity. You can literally go take that equity, take it out, convert it into cash for you to go do a deal, right? You can tap into sometimes your life insurance policies. You can sell stuff. I mean, there's so many creative ways to actually raise capital. You can tap into your credit cards. I've got a good friend who started his whole business by just maxing out credit. I'm not recommending this, but it's possible for you to sort of max out the credit cards. You can use that capital to go buy your first property if that's what your stage is at. So there's different ways to raise capital.
And the reason why we wrote the book is because the minute that you go outside of you,
right,
then it's actually considered a security.
Yeah.
Right.
Yeah.
And I think that's the most important thing. A lot of people, which is fine, don't feel comfortable doing anything outside of themselves. And that's totally cool. Like, it's no big deal. But most people are trying to figure out, like, how do I bring in another partner for this or that? And then if you do that, that's considered a security, right?
Yeah.
And so now you're in a different arena, and that's the purpose of the book, is that, there are steps that you have to take to protect yourself and protect your investors, right? Because the whole goal is not to do one deal. It's to do many deals over a lifetime and leverage other people's money.
Yeah, I mean, that's one of the main reasons you do it. I mean, if you're a real estate investor and you get excited about starting out, and you start just like you did, started with your 2-bedroom, 2-bathroom condo, eventually you're going to run out of money. So your options are either A, throw up your arms, say, well, I'm out of money, and so I'm going to have to wait for another year or two to save up my down payment for the next investment property. Or you're going to say, forget that, I'm going to keep going, but I'm going to have to access other people's money to help me continue to acquire assets, assuming you're good at it and you've actually created a return with your first and second and third property. Then yes, go to friends, family, people potentially you don't know, institutional investment. We talk about all those different types of capital in the book, but that's when you would go to the market because you've run out of your own funds.
Yeah. So Danille, you're a great example, actually, because we live two very different lives. Like, Danille does not raise money from other people yet. Now, she might, but at this point, what you've done is you've put all your own money into a deal, managed it well, and then you've done a line of credit against it and bought another deal, and you've slowly done that, and you've got a lot of property now.
Yeah. And
right?
For me, that's what I prefer. But, you don't scale as fast doing that because you're obviously having to rely just on yourself. And looking back, if I would have done that and then, all this increase in prices we would have had, I would actually be in a better position. So there's good and bad either way.
Well, maybe.
And our good friend Robert Kiyosaki would say you're selfish because you're only raising money, or you're only doing properties for yourself, and you're not sharing that wealth with everybody else.
Well, I remember like the very first deal that Danille bought, was it 230 grand or 230 grand, and in Scottsdale of all places, right? And she used her own money. That was completely awesome.
Yeah.
But had you bought 8 or 10 or 12 other places in that little neighborhood,
I would have been happy if I'd have just bought one other one.
Yeah.
There was one listed a few doors down.
It's interesting because those houses are whether 500 grand today,
Yeah, about
probably.
5,
yeah. So they've doubled in price, and I don't know what time frame, but less than 10 years, I suppose.
5 years, yeah.
5 years. So, but that doesn't mean you should have, right? Like, because there's consequences, and that's kind of the point of the book. Like, you can't just go raise the down payment because now you have a partner that now they're going to want reporting. Now they're going to want you to communicate to them. They're going to want a return on their money. There's all these other consequences that come with taking somebody else's money.
It's an awesome and serious responsibility for sure.
So that kind of brings me to my next question. So what separates the operators that are still raising capital versus the one that are struggling to get investors?
Probably today, how they handled the last few years, right? Again, I'm going back to that example. There's the operators. Look, it's been a tough time for the last 5 years. So there's no operator out there that I know of, and I think you would agree, Ken, that just crushed it the last 5 years. It was all about survival and just getting through it. And so the good syndicators got through it, and that helps a ton now because now you've gone through that. You've gained the trust, or you continue to have the trust. You've shown your investors your transparency because, again, everybody was having issues.
We've had a couple issues. So, it's not fun.
Yeah, it's not fun. But you communicating, you're showing them the exit plan. I know you were very preemptive with a lot of your potential issues that were coming down. You did a lot of cash. What is it called? The cash ins that I love that you were brought.
We did some cash in refinances, but we also did some cash calls, right? And then we were in a situation where we're trying to hold on to projects, and we had to sell some projects as well, and take some losses. And it's unfortunate, but you have to make sure. We've been through this before. 20, almost 30 years investing, so. There are things that you have to look at when you get to that.
Yeah, and if you're one on the other side that didn't do so well, and not only didn't you do well, but you also didn't communicate and you kind of lost that trust, it's very difficult. I mean, trust is a tricky thing. It takes a while to build it up, and it takes a second to lose it. And if you lose it, it's not something you just can regain right away.
Did you see, since you worked with a bunch of syndicators over the last few years, there was an age difference in how people communicated? Because, I think we all can know that, like, maybe the younger generations, there's less and less communication, right? Like, everything is a text message, a short email, not wanting to face that hard phone call. So did you notice
That's a
that
good
at
point.
all?
I
That's
didn't.
a heck of a
That's
point.
a great point. I don't know if that is a generational thing, and an older folks may have done more of the written stuff. But no, I've got investors who literally, would pick up the phone and say, hey, look, the payment's coming in or the payment's not coming in. But I saw people who lost money, but they did it, if there is such a thing, they did it the right way, where they were constantly communicating. They had plans. They were keeping them up to date, and then finally would come out with an email and say, look, we've looked at all the options we have, and we're deciding on this option. It's not the best option. It's not the greatest result, but it's the best option of all the options we have. You might even take a haircut. It may have to require a cash call, but it's a thoughtful process of how do we get from the trouble we're in now, which you could argue maybe was their fault, maybe it wasn't their fault. Obviously, a lot of things happened over the last 5 years, and especially in terms of interest rates skyrocketing so fast, to then coming out with the game plan. And I think if you show that path, I think that just goes a long way on when it comes to trust versus just not even reporting anything and saying, sorry, guys, you lost all your money.
Yeah, it's not comfortable in either way. I will tell you, like when here's the deal. If any real estate, doesn't matter who you are, that was purchased, prior to the last few years, has gone down in value. Everything's down. It's not, yes, there were some poor purchases for sure. And yes, there's some horrible deals. But even the ones that were purchased correctly, even the ones that were already owned, have gone down.
Yeah.
Right?
Yeah.
I think it's important to realize, like, the whole market went down. This is not just a select few deals that people lost because they maybe they bought incorrectly. Those are part of that.
Yeah, and obviously you talk about the cost of capital, but that's also the part that's gone through the roof. And so just sort of as a quick history lesson, I know we've talked about this before, but the challenge was that after COVID, with the dramatic increase in prices, the lenders were the numbers just didn't add up. Your debt service coverage ratio, meaning how much money the property was making in relation to how much the debt was, didn't pencil anymore. And so lenders weren't lending 80% anymore. They started lending 60% or 50%, which didn't pencil for syndicators. So syndicators had a choice. Do I stop raising money and stop buying because the lenders will only give me 50%? Or do I go to a little bit more aggressive loan product like a bridge loan? And that's what most people did. They went to a bridge loan, which allowed them to stretch the leverage a little bit more back up to the 70, 80%, but it came with strings attached, which means you were getting a fixed rate, but only for 3 years typically. And then those rates will start resetting. And of course, nobody thought that interest rates would go up so fast, so quickly as they did. And so a lot of people literally got caught with their pants down.
And at the same time, they were also repricing their equity.
Right.
That was the other thing. So let's say they started at 6, and then they went to 7, and then they went to 8, and they went to 9, and I saw some over 10.
Yeah. Well.
Right. And so, again, the cost of capital gets paid from the property. Like, everybody forgets this. Like, let's don't forget where all money flows from the property up, right?
Yeah.
Like everything. It pays for the mortgage. It pays for the people. It pays for the utilities. It pays for the property tax. It pays for the insurance. It pays the investor. So everything flows from the property.
Can you talk a little bit about the importance of having different exit strategies? Because one of the culprits here is that everybody had one exit strategy, which is, hey, I'm going to buy this property, I'm going to refinance it in 2 years, and then I'm either really going to refinance it and get a permanent loan. When that didn't happen, there wasn't a plan B.
Yeah, well, I think there's a great question, by the way. Yes. One trick pony, right? Like, you got to be careful of that. Here's the thing. If you're buying a property today, it should cash flow today. That's number one. Cash flow today, cash flow tomorrow, cash flow next year, cash flow the year after. So if nothing changes, then it cash flows. That's really, really, really important. Obviously, you want to try to fix your debt. What caught a lot of people, including us, is that if there was any kind of a value add, you came in with what would be called floating debt while you were renovating a property. and then you got caught in that rate increase while the properties were being renovated. Because what you were trying to do is you were trying to capture that value add, right? If there was no value add, you would have just fixed your loan, right? So that's what caught a lot of people, right? And so the key to all of this is having the cash, making sure it cash flows, and also having a long view horizon,
right?
Like 7 to 10 years, and then if you're lucky enough, because here's what I always tell everybody: in 2007 and 2008 and 2009, when I was buying, there was no value add. I think that's a really important piece. So I was just buying based on the asset, what it produced today, and what did it cash for or not. Then what happened was 3 or 4 or 5 years later, we started to see, this is a potential value add. We already owned them. So all of a sudden we had all these assets that we had bought correctly with the cash flow that now had value add opportunities. And that's when we started putting new debt on and started doing value add, but we already owned it. Yeah. So it wasn't the reason we bought it.
Right. But even if it cash flows from day one, if your interest rate starts creeping up from 4% to 5% to 6% to 7%, that's, I think, one of the main issues.
Yes. Then there's no cash flow.
Yeah.
Correct.
So you have to be able to project worst case scenarios or what happens if in the subsequent years, because there's a sort of a break even point where, like, man, once the interest rate hits this point,
that's the thing. Yeah, that's the cash in refi, what you were mentioning before. As we started to see rates run, we aggressively said, okay, we need to get into this fixed rate product. And we were doing cash in, which meant that we were, instead of doing a cash out refi, we were actually paying in to hedge our debt costs, right? And we did that on most things, but there were some that we weren't able to.
Yeah.
And then you could buy rate caps and all these kinds of things, which we also did, but they're only typically a year, right? So then what happens in the second year, and the cost of those rate caps went up. So to your point, if the whole thing is based on tomorrow being more, then that's a risk. If you can base it today, cash flowing today, and realizing that it might not be more, and still a good investment, you still get your depreciation, you still get your cash flow, and then kind of wait for that opportunity. That's a better strategy.
And the one thing I want to mention, that I don't want to scare too many people away, that is, as long as you're disclosing all of these risks, that is your number one obligation and if you're raising capital, that's your number one obligation, is disclose all these potential scenarios. Because if you disclose them and that scenario happens, it is what it is. Like, that was part of the risk. This is not an ATM machine. Otherwise, you'd be getting paid 5% or 4.5%. So there is risk involved. And as long as you identify the risk, which is why you want to have a good lawyer with you, help you identify the risk and properly articulate that risk in the PPM, you're going to be just fine. Even if you lose all of the money, if there was a disclosed risk, a properly disclosed risk, at least from that perspective, you'll be fine from the security side.
And the problem is most people just don't see those risks, right? Like, so that's why we're kind of going back to people that haven't been in the business very long, people that are just capital aggregators,
right? People
that are young, right? They haven't been through cycles yet, right? They don't know what the risks are. And so the workaround would be to find somebody seasoned or an attorney like Mauricio who can disclose all those risks for you, both in the business plan and both in the PPM. And that's, that was one of the things we focused on in the book, The ABCs of Raising Capital, is these are things that you have to put in there if you're going to put your toe into the raising capital arena.
So I think it's important to note that, this book is not just for people that want to raise capital, but I also think it's great for investors looking to invest with somebody, because you need to understand what raising capital means and all the rules and regulations around it. So if you can look at your own deals and you can kind of say, okay, is this correct, right? Is this what I should be doing?
Yeah, like if you're an LP and that's a great point, because if you're reading the book and you're like, okay, well, I'm a non-accredited investor, I'm sophisticated, but I don't have the high net worth, then I should be expecting a particular document, a private placement, and I don't get one.
Yes, then you'll
that's
know.
A red flag.
You'll
like,
know. It'll be in the book.
Yeah.
Must be, right?
That's a red flag right there. Like, why? And then they start giving you the runaround as to why, and it's really just because they're trying to save some money and cut corners. And then the question becomes, okay, well, if you're cutting corners here, where else are you cutting corners? So understanding the process. Again, you don't have to know all the rules and the regulations, but just having a high understanding. And we did write this book to try and just be contextual. It's you're not going to get 1,000 statutes in here or anything like that. That's not your role either as a GP or an LP on the legal side. It's just to be aware and know enough that you can identify potential issues when they arise, and then talk to the right person to address those issues.
A pleasure working with you on this book because, you know, I know it from the operator side, you know it from the legal side. And so when we met, gosh, over a year ago, we said, let's do this project together because, you know, you can see it from the legal point of view and I can see it from the operator point of view. And I guess this is a kind of a meet in the middle book that you were okay with and that I was okay with. And I think we put out a pretty darn good product here.